Welcome to the People Stack. This is where we try to break down the complexities of people, policy, and payroll, especially for founders and small businesses here in India. Today, we're tackling something really fundamental if you manage a team in India, the Provident Fund. PF, if you're building a startup, maybe scaling your small business, or even just thinking about your next venture, this discussion is definitely for you. Now, before we dive deep, just a quick but very important heads up. We aim to give you solid, well researched insights today. But look, compliance stuff is tricky, it's nuanced. So, always, and I really mean always, talk to a qualified PF consultant or a legal expert for advice that fits your specific situation. Think of this show as your info boost, not a replacement for professional legal counsel.
Okay, right. So with that critical point made, let's get into it. What is PF? Really? Why is it such a big deal beyond just, checking a box? How do you actually get registered? What are your monthly tasks? And maybe most importantly, what happens if you fall short? Let's start with the basics. At its heart, what exactly is the Provident Fund?
Well, in India, the Employees Provident Fund (PF) it's a mandatory savings scheme for retirement. Crucially, it's not some optional company perk. It's backed by the government and it's managed by the EPFO, the Employees Provident Fund Organization. The whole idea is to build a financial safety net for employees, for later in life.
And what's really key here, I think, isn't just that it's mandatory, but when it becomes mandatory, the law is pretty specific. Once your business hits 20 employees, and this is important, that count includes full-time, part-time, and sometimes even certain contract workers, which catches founders out sometimes.
Right.
You absolutely must register for PF and start contributing. It's like the government saying, okay, your business is growing up, time to step into this wider social contract. It shows a commitment to your employees' future.
And these contributions, it's a shared thing, isn't it?
Exactly.
Typically, both the employer and the employee put in 12% each based on the employee's basic wages and dearness allowance, usually, every single month. And that money, it doesn't just sit there. It goes into a unique PF account for each employee. It earns interest over time. And while it's mainly for retirement, you can access it earlier for specific things, buying a house, medical emergencies, education sometimes. It's meant to be somewhat flexible.
Which leads to a really important question people ask. Is it only a savings plan? And strategically, the answer is definitely no. If you look at the bigger picture, PF is, well, it's a whole Social Security system rolled into one. It's quite a robust national framework, providing benefits that, frankly, would be too expensive for most small businesses to offer on their own. It actually has three parts. There's the Provident Fund itself, that's the main savings bit. Then there's a pension scheme, which gives a regular income after retirement. And third, there's life insurance cover through something called EDLI, the Employees Deposit Linked Insurance Scheme.
EDLI, right.
Yeah. This pays out a lump sum to the employee's family if the employee passes away while working. It's vital protection. So it's really a comprehensive package.
And that's the big plus for employees, isn't it? They get these really significant benefits, the pension possibility, the life cover, without paying anything extra beyond their normal PF contribution.
Precisely.
It becomes this incredibly valuable part of their compensation package, even if it's sometimes overlooked. It definitely helps your image as an employer.
Okay, so for small businesses, particularly early on, PF might feel like, just more admin, more red tape. But why should you as a founder really care about this beyond just staying legal? What makes it so foundational?
Yeah, it's easy to see it as just a legal hurdle initially, I get that. But the deeper insight is that getting your PF compliance right signals you're building a trustworthy business, one that thinks long-term. It tells your employees, potential hires, even the market, that you're serious and reliable. It's less about avoiding fines and more about actively building a good reputation. And the tangible benefits for the business itself, they're pretty significant. Knowing their future savings are being handled properly boosts employee confidence, morale. That directly helps with keeping your team together.
Retention, yeah.
Definitely. It keeps you legally safe, obviously. But here's something founders often miss. Banks, and even big clients, frequently ask for proof of PF compliance.
Really? For loans and contracts? Absolutely. When you're applying for business loans or bidding for larger contracts, they see it as a sign of stability and good governance. So messing this up can actually block your growth. It can affect your funding, your ability to win deals.
Wow, okay. That really hammers home the strategic angle. It completely debunks that idea that maybe you could cut corners on PF for a bit to save cash because the penalties if you don't comply, they're serious. We're talking up to 25% extra slapped on as damages, plus a hefty 12% annual interest on anything you owe. And in really bad cases of default, you could even face criminal charges. So any tiny saving you thought you made just evaporates against those massive risks.
Absolutely right. The financial consequences are designed to be a very strong deterrent. The EPFO doesn't mess around when it comes to recovering dues.
Okay, so we understand why PF is so crucial. The next logical step for any founder is, all right, when do I actually have to do this, and how do I start the registration?
So the trigger point for mandatory registration, like we mentioned, is hitting that 20-employee mark. And just to reiterate, that count usually includes your full-timers, your part-timers, and potentially certain types of contract workers, too. It's broader than just your permanent payroll sometimes.
Good point. But what if you're smaller, fewer than 20 people? Well, you still have the option to register voluntarily, which can be a smart move, actually. Shows you're proactive, helps attract talent early on by offering that security.
And another critical thing to understand, once you're registered for PF, you're generally in the system for good. Even if your employee count drops below 20 later, the business usually stays under PF rules. You can't just dip in and out easily. Getting out requires a formal closure process, which isn't straightforward.
Okay, so it's a commitment. Now, the good news here is the registration process itself. It's actually become pretty smooth, mostly online. You basically go to the government's Shramsivida portal registration.shramsivida.gov.in. You set up an account there, and that helps generate your labor identification number, or LIN. Think of the LIN as your unique ID for all sorts of labor compliance.
A single ID, yeah.
Exactly. Then it's mostly about filling in your business details, owner info, uploading the necessary documents, things like your PAN card.
Your tax ID.
Right, your permanent account number,
Right.
Address proof for the business, maybe some licenses depending on your industry. The final step is digitally signing the application. You can usually do this using Aadhaar e-sign or a DSC, a digital signature certificate. These are just secure ways to sign online.
Verifying your identity digitally.
Correct. You submit it, and then you wait for your official PF code or establishment ID to be issued. It's designed to be paperless.
And that online convenience doesn't stop at registration. That's key. Once you've got that PF code, all your ongoing monthly tasks, the filings, the payments are managed through another official portal, unifiedportal-emp.epfindia.gov.in. The whole ecosystem is pretty much digital now, which really cuts down on the old school running around.
Okay, fantastic. So you're registered, you have your PF code. Now what? What's the regular month-to-month responsibility? What are the must-dos? Well, number one, without fail, pay your contributions by the 15th of the following month. So January's contributions are due by February 15th. And it's not just about sending the money. You also have to file something called an ECR online.
Electronic Chal-Income Return.
Right. That's basically a digital statement listing out the contributions for every employee for that month. And obviously, you need to deposit both shares, the amount deducted from the employee's salary and the employer's matching contribution. Beyond the money stuff, you also need to keep employee details updated. Things like their KYC, know your customer info, so basic ID and address proofs.
And nominations. Who gets the money if something happens?
Exactly. And nomination details, too. That's super important. And finally, you'll probably find yourself helping former employees when they leave, assisting them with transferring their PF balance to a new employer or making withdrawal claims.
Now, here's a really critical point that trips up a lot of founders, leads to needless trouble. It's the nil return.
Ah, yes. Explain that.
Okay, so even if you have 0 employees contributing in a particular month, maybe you're between projects or it's a seasonal low, you still have to log in and file a nil return through the portal. And usually you have to pay a very small administrative fee alongside that nil return.
Even with no contributions.
Yes. If you don't file that nil return and pay the small fee, your PF code can technically go into default status, which means potential penalties down the road just for missing that filing. So you have to stay active in the system even when there are no active contributions.
That is such a classic gotcha. A small admin task missed. Big headache later. Okay, so let's pivot to best practices. How can founders make sure compliance is smooth, avoid these kinds of traps? My first thought, enroll everyone who's eligible. Don't try to get creative with classifying people to avoid it. The rules are pretty clear on who qualifies. Just include everyone you're supposed to. No exceptions based on contract type or salary if they meet the criteria.
And tied to that, educate your team. Seriously. Many employees, especially in smaller companies, might not fully get that PF is their money, their future savings.
Yeah, they just see the deduction.
Exactly. They might just see it as another deduction from their payslip, not as a long-term asset being built for them. Taking a little time to explain what it is, how it works, why it's valuable, that builds huge trust, it helps them see the benefit you're providing.
Totally agree. On the admin side, be meticulous about your digital stuff. Keep your DSCs, those digital signature certificates, up to date. Make sure your authorized signatory details on the portal are always current. An expired DSC can literally stop you from filing on time, creates a huge scramble.
And speaking of time, I know we've said it, but I have to say it again. Pay contributions on or before the 15th, every single month. Honestly, it's the simplest, most effective way to avoid all the interest and penalty issues. Just be punctual. It's a financial imperative, not just good practice.
Absolutely. And a big warning. Only use the official EPFO portals for everything. Your payments, your filings, managing employee data. Avoid those, slightly shady third-party services that pop up promising shortcuts. Stick to the official channels. It's the only way to be sure.
That's right. And another good habit is to periodically review the contributions. Just check that the amounts being deposited match your records and are showing up correctly in the employee's individual PFF accounts online. This kind of regular check can help you spot any errors or discrepancies early before they become a big mess to untangle.
Good advice. Finally, what if you're confused about a rule? Government stuff can be complex. Don't guess. Seriously, don't guess. Reach out to your regional PF office directly. They exist to help. Also, the EPFO often holds these monthly public help sessions, sometimes called Nigi Apken Nikat.
Yeah, those are useful.
They're a fantastic resource for founders. You can get questions answered straight from the source. Use those official channels when you're unsure.
Okay, we've covered the what, the why, the how to register, and the how to stay compliant. But let's just circle back one more time to the consequences of getting it wrong. What's really at stake if you don't nail this down?
Well, the financial hits are real and they scale up. We mentioned the 12% annual interest on late payments. That's standard. On top of that, the penalties, the damages can reach up to 25% of the amount you owe. And it's tiered, meaning the longer the delay, the higher the penalty percentage.
So it gets worse the longer it goes on.
Exactly. It's designed to encourage prompt payment. And if a business keeps defaulting, it doesn't just stay financial, does it? No, the legal actions get tougher. The EPFO has powers to recover the money, including attaching the business's bank accounts.
Or even attaching business property in some cases.
Right. These aren't just slap-on-the-wrist fines. These actions can seriously disrupt or even halt your business operations.
But the absolute most severe consequence, and every founder needs to understand this risk, is the potential for criminal prosecution. Jail time.
Jail time. For PF non-compliance.
Yes, specifically for what's called criminal breach of trust. This typically happens if the business deducts the employee's share of PF from their salary, but then fails to actually deposit that money with the EPFO.
So you took the employee's money but didn't put it where it belongs.
Precisely. You've essentially withheld their savings. And the law treats that extremely seriously. It's seen as a fundamental betrayal of trust and potentially criminal.
Wow. That really paints a stark picture. The EPFO is clearly uncompromising when it comes to protecting workers' savings, which just underscores why businesses have to be just as rigorous about it. It's not just about avoiding trouble. It's about basic responsibility to your team and, frankly, protecting your business's own future. So, wrapping this up. It's easy to look at Provident Fund and just see, paperwork and rules, bureaucracy. But when you really think about it, it's actually a fundamental pillar of financial security for millions of workers across India. It's a core part of their long-term stability.
And for you, as a small business owner or founder, getting PF compliance right from the start, or getting it sorted if it isn't, builds enormous trust and credibility. It sends a powerful message to your team, to your partners, to potential investors, that you're building something solid, responsible, and ethical.
So here's something to mull over as we finish. If you're starting or growing your business right now, how can you make PF compliance not just a legal task, but a core strategic part of your people operations? How will getting this right contribute not only to staying out of trouble, but actively building your company's reputation and helping you keep your best people for the long haul? Think beyond the checklist. Stay compliant, stay empowered. This has been the People Stack.